Hello traders! Ever wondered how to determine if a stock price is genuinely low or misleadingly high? I am sure for the traders out there, you might have experienced this before. Buying a stock at a price you thought was low, only to find out it was high instead. Personally, I've done it a few times and it can be demoralizing. I learned it the hard way, and I hope you can learn from my mistakes, as navigating stock prices effectively is crucial, especially when targeting significant investments like Singapore banks. So, the main question is, how do you buy and sell Singapore banks at a reasonable price? My name is Minghan, Senior Dealing Manager from the CFD Department at PhillipCapital. Today, we will explore the use of price-to-book ratio and additional tools to identify entry and exit points that make financial sense. Are you ready? Let's begin. Today, I'd like to talk about how I use price-to-book ratio, also known as the PB ratio, and something more to decide on a reasonable price for entry and exit. I will cover three aspects on this metric. Number one, why use PB ratio? Number two, PB ratio, what it is, how to interpret it. Number three, the missing puzzle to help you decide. With that, let's begin with the first point. Why use PB ratio to value banks? Banks are typically valued using the PB ratio because it provides a useful measure of their financial strength and profitability. Here are some reasons why the PB ratio is commonly used to value banks. Asset-heavy businesses. Banks are asset-heavy businesses, meaning they have a significant portion of their assets in loans and other financial instruments, and that's how they make money. The PB ratio provides a way to assess the value of these assets relative to the market value of the bank. Regulatory capital requirements. Banks are subject to regulatory capital requirements, which set minimum levels of capital that they must maintain. The PB ratio can be used to assess a bank's compliance with these requirements. Book value. The book value represents the net worth of the banks, which is calculated by subtracting liabilities from assets. The PB ratio provides a way to compare the market value of the bank to its net worth. It's important to note that the PB ratio is just one of several factors that should be considered when valuing a bank. Other factors such as asset quality, earnings quality, management quality should also be taken into account. That sums up our first point on why we use PB ratio. Next, let's delve into what this metric is exactly and how we make sense of it. PB ratio. P refers to the current price of the stock. B refers to book value. We can simply see it as net assets, using the company's assets minus the company's liabilities. The price-to-book ratio is a financial ratio calculated by dividing the company's share price to its book value per share. It is commonly used to value banks. For example, if the stock price is $30 and the book value per share is $20, then the PB ratio is 1.5. Now, how do we interpret the ratio? Here's a cheat sheet for you. If the PB ratio is greater than 1, the company is overvalued. This can be due to several factors such as strong growth or competitive advantage. If the PB ratio is exactly 1, it suggests that the company is fairly valued and matches the book value. If the PB ratio is less than 1, the company is undervalued. This can be due to financial distress, poor management, or simply the market valuing the stock at a lower price. This sums up our second point on how to interpret the PB ratio. Now that we know why, what, and how most people use the PB ratio, a crucial question remains. Do we buy stocks when the PB ratio is less than 1 since it is undervalued? Let's explore what the historical data for UOB, OCBC, and DBS from 2019 to 2023 can tell us about this strategy. Before we proceed, it's important to remember that past performance is not indicative of future results, yet it can provide valuable insights into the stock's behavior in relation to its PB ratio. Starting with the UOB chart, the black line is when the PB ratio equals to 1. For UOB, if you bought when the PB is less than 1, you would have gotten the stock at a substantially lower valuation, a rare opportunity that might occur once in 5 years, providing you significant investment potential. For OCBC, similarly, this opportunity happened once in 5 years. Last but not least, for DBS, this opportunity also happened once in 5 years, but only for a brief moment. Although buying a stock when the PB is below 1 could be seen as a golden opportunity, such occasions are rare and typically tied to extraordinary circumstances, like the COVID-19 pandemic. However, waiting for such rare events might not be practical for active trading. So, does this mean that PB ratio is not useful? Here, I will share with you the missing puzzle piece related to the PB ratio. With this puzzle piece added to the approach, it can give you more trading opportunities. The missing puzzle piece I'm referring to is the comparison between the average PB ratio and the current PB ratio. Let me explain with two examples. Look at the image. The blue line is the difference between the current PB ratio and the average PB ratio, and this is what I call the discount line. When it goes below 0, it signifies that the current PB ratio is lower than the average PB ratio. For OCBC, rather than waiting for PB ratio to go below 1, more trading opportunities can be seen when there is a slight discount, marked by the grey arrows. Using DBS as my second example, while priced at a premium, notice how the price bounces when the discount line is at 0 instead of below 0. Imagine if you are a trader waiting for PB ratio to be less than 1, like I mentioned earlier, this wait could take up to 5 years or even more. From these examples, I want to bring across the point that you don't have to wait for the PB ratio to be less than 1 to trade the bank stocks. Using the discount line to monitor and compare current PB ratios to their historical norms means you can trade them when the discount is reasonable enough. In a hypothetical scenario, let's see what happens if a trader actually applied this strategy. On 28 February 2024, the discount line presented an opportunity to enter UOB at $28.24. Fast forward a month later, from the image, it would be more than 5% return. Now, when should the trader sell? Remember we talked about how when the discount line is at 0, it is a reasonable entry, but if you follow the discount line closely, 36 would be the price to consider, as the discount line climbs above 0 and signals that current PB is higher than the historical average. As we never know how the market would unfold, if you have holding power, wait for the discount line to hit the red dotted line, as that is a potential resistance. In addition to the strategy above, you can also consider CFD. CFDs are leveraged products that can help make your money work harder. Using our DBS example, this would mean that instead of a 6% return, the leverage would allow you to have a 60% return on capital. In fact, there's a promo now that can give you $30 cash credit when you trade CFDs with us. However, it is important to acknowledge that there are risks associated with leveraged products such as margin calls, amplified losses. Always conduct your due diligence and seek advice from financial experts before engaging a counter or instrument for your investment. If you like this indicator, I want to invite you to join our traders community in this Telegram channel, where I'll share further instructions on how to get the most value out of this proprietary indicator. I hope this session gave you an idea on how to buy and sell at reasonable prices. If you have any questions regarding CFD trading, you may reach out to my dealing team or myself. This is all for this episode of PhillipCapital's Market Watch. Do remember to like and follow us on our social media handles and subscribe to us on YouTube. Take care, and I'll see you soon. Trade safe!